So hey there everybody, Josh Cantwell here, CEO at strategicrealestatecoach.com, and welcome back to another one of our fantastic interviews. Welcome back to our podcast, Strategic Real Estate Coach Radio. We're really excited to share with you some amazing information today on what's happening in the single family rental market and the maturation of that marketplace. And what I've decided to do is really bring, one of the guys that I rely on for this amazing data that tells us what's happening in the marketplace. His name is Daren Blomquist. Daren is the Senior Vice President at Adam Data Solutions, which is the parent company to RealtyTrack. Many of you are probably familiar with RealtyTrack and their website and all the foreclosure data that you can get there. But Adam Data Solutions is one of the nation's leading provider of data and information, demographics, trends of what's happening, and the algorithms that they use and all the data that they aggregate. They use this data to tell major news outlets what's going on in real estate. Matter of fact, Daren is going to be on another separate interview about 30 minutes from now with CNN Money. So we're happy to have Daren on, squeeze him in, just finally able to get him on the line today, and just for a very limited time. So Daren, thanks a lot for joining us, and tell us what's going on. What's going on in the real estate market? What's going on at Adam Data Solutions? Happy New Year. Let's welcome everybody to 2018.
Yeah, Happy New Year to you. Thanks for having me on. And yes, things are going well, already hopping in the new year for us. And by the way, yes, CNN wanted to talk. They wanted to do the interview right now, but we said, no, we've got Josh Cantwell to talk to. We've made that commitment. We're going to stick to it. So they were willing to push back for that. But yeah, what they wanted, one of the hot topics of today, and I think this is going to be a hot topic for different reasons going forward this year. One of the themes we're going to see is, but the hot topic they want to talk about is Amazon just announcing their top 20 list of cities that they are going to put their second headquarters in, and they've narrowed it down to 20 cities. And CNN wants to talk about, well, what kind of impact is that going to have on the real estate market? We've seen it in a great example is what we've seen in Reno over the last few years after Tesla moved there. So I think a theme, though, you're going to see this year with the Apple announcing that they're repatriating a bunch of their money and going to set up another headquarters as well, is this idea of where are the jobs going to be moving and this year. And I think we'll see some surprising places that aren't currently job centers that maybe become much more job centers because these major corporations realize that where they are is highly unaffordable for their workers, and so they're looking for markets that are a little more affordable. Of course, there's other factors that they take into account as well, but that's one of the big things is housing affordability, and that's going to have a big impact on some of these real estate markets as we see some of the big corporations make those decisions, as well as smaller businesses migrating to areas with better housing affordability.
Yeah, it's really amazing that the affordability difference between San Francisco and major, a New York, Seattle, versus your Midwest Rust Belt areas. Properties are 3, 4, 5 times as expensive, and the incomes are not 3, 4, 5 times as much. And you have great towns. You have obviously Cleveland. I'm very biased, but you have Columbus, Indianapolis, St. Louis, Chicago, a lot of Nashville, a lot of great Midwestern towns. And of course, how is that if Apple or Amazon were to open up a second headquarters in one of those cities? How does that impact the real estate market there? Is really an amazing thing to talk about. A great thing to kind of forecast and discuss over coffee and what that might look like. So that's an amazing thing. I'm excited to see, those 20 cities and how it narrows down. Unfortunately, Cleveland's not one of the top 20, but Columbus is. It's only 2 hours away, and it'd be a great thing for the Midwest and for Ohio for sure. One of the things that we specifically asked Daren to talk about and to jump into is what's going on with single-family rental properties. We're seeing a lot of movement, maturation in people owning rentals, both on a onesie, twosie level, on a 10s and 20 level, and now also people migrating up to owning hundreds of units of single-family rentals. I don't think anybody will ever forget about 5 years ago when Warren Buffett got on a live television interview and said, if I had the ability to buy hundreds of thousands or millions of units of real estate right now and do it at scale, I would do it. That was about 4 or 5 years ago, and all of a sudden you saw all these brand new institutional money come into the single-family rental market. And then that turned into a lot of single-family lending. Companies like Lending Home, Lima One, Freeland Ventures, companies like Vizio and Finance of America. These companies, a lot of them were an offshoot of companies that started buying single-family rentals, and that single-family investment, that play was so successful, they made so much money that they then started pivoting into lending. And so I've asked Daren, with all of the data at his fingertips at Adam Data Solutions, to tell us what's going on with the single-family rental market. So Daren, let's jump right in, man. Let's go through some of these slides and give us an update. What's the latest?
Yeah, just to give you just a little bit of background on the methodology, this is based on public record data we're collecting from county recorders' offices and tax assessors' offices, and then we supplement that with other data around that, but that's the core of it. So just so you know, every one of these numbers that I'm going to talk about, I think everyone, maybe I'll tell you if there's an exception, is tied to an address that we have in our public record database nationwide. So just to give you that methodology, it's not a survey, it's not an estimate, it's actual hard numbers, and these 19 million properties you see on your screen right now, those are 19 million homes that we have in our public record database. And specifically what we're looking at here are properties, single-family homes that are non-owner occupied based on the tax assessor's data, and there's a couple ways to determine that. But what we wanted to look at, there's not a lot of historical data on what's been going on in the single-family rental market. It's long been the domain of smaller mom-and-pop investors. But we wanted to look as these institutional folks had jumped into the market, to your point a few years back, what's been going on and how this market is changing. And so we took a snapshot at the beginning of last year, and then we took a snapshot near the end of last year, February and November. And this graph maybe is a little deceptive. It looks like there was a huge jump. It really went from 19.2 million to 19.5 million single-family rentals. So the number of rentals did increase by about 2% between that time. Primarily, a lot of that just being new acquisition. Folks going in and finding existing homes that used to be owner-occupied, now converting those to non-owner-occupied rentals. And then there's a rising trend of build-to-rent. Some of these are new homes that have been built, and specifically as rentals, that account for this difference of 2% between those two times. But then, yeah, if we go to looking at the number of entities, and we look at this based on the name of the owner or entity that owns the property, as well as their mailing address, we match those up because sometimes people can have multiple LLCs going to the same mailing address. But when we look at that, we see the number of owners is shrinking quite a bit.
Wow.
And that speaks to the consolidation. I believe the percentage, if I did my math right, is around 14%. But anyway, as opposed to about 300,000, an increase in 300,000 in properties, there's a decrease in about 2 million in number of entities owning the properties. And this really speaks to consolidation in the industry. Some of the players, where we really see the movement is in what we would call the middle tier of the market. Folks who maybe own 10 properties now moving up, and you'll see that actually in the following slide here, is moving up into owning 11 to 100 properties. And then also folks who owned maybe hundreds of properties moving up into owning thousands of properties. And a lot of that is happening through portfolio sales. And there are there were some institutional investors when Warren Buffett said that back, I think it was in 2012 to what you mentioned earlier. There were some opportunists who said, "Hey, that's a great idea. Let's jump in, make some money off of the fact that the housing market is at the bottom right now." And some of those guys are cashing out. They're liquidating their portfolios, and those portfolios, though, are mostly not going to owner occupants. They're going to other investors who are in it for more of the long haul, and they're taking on those portfolios. And that's why we see that number of investors is shrinking.
Yeah, I like to see that back in this previous slide. In that, what I think to your point, you see there's more financing available for single family rentals. So you have more available cash both on a onesie twosie and on a blanket loan or a line of credit loan or on an institutional loan. There's more institutions, banks, etc., hedge funds that are willing to make loans for single families, but you're seeing people really, I guess, professionalize, if you will, professionalize, no longer always mom and pop, but professionalize the single family rental business and do it at scale. And guys who were previously owning one or two are now owning 5 or 10. Guys that used to own 5 or 10 are moving up. And then guys that, like you said, own hundreds are now owning thousands, or guys that own thousands are consolidating their businesses. Will say, hey, you own 1,000, we own 1,000, let's merge, or let's one of us buy each other out. All of that is happening, and I think it just speaks to not only the professionalism, the financing available, but also the fact that this is just a really solid investment. You know, people wouldn't be in the investment rental business if it wasn't something that was consistently producing returns. For me, appreciation is a bonus. It's all about value real estate investing, buying at a discount, adding value by doing improvements, forcing the appreciation, and then renting properties out at scale. And appreciation is always a bonus. But of course, over the last 5 years, we've seen lots of appreciation as well. So those are some of the different things that I see, just kind of boots on the ground with myself and my students, and what we're seeing from them. Tell us a little about some of the, more larger percentage, different cities that have higher percentages of single family rental properties.
Yeah, a lot of these are going to be in the middle of the country. You do have Las Vegas and Riverside, California, which is basically here in Southern California where I live, the Inland Empire. But a lot of them are Middle America or the Southeast, and these are markets that do tend to not, at least historically, have not had a ton of appreciation. You think of an Oklahoma City, and so it is a great place to own a rental for cash flow and hold it for the long term, as opposed to trying to time the market and time the ups and downs. You're not going to do very well trying that in a market like Oklahoma City. And but one of the other things here that we see opportunity for, I wanted to mention, on the home flipping side of things, for folks who are, how does home flipping tie into this? In many of these markets, I would say I would include Oklahoma City, certainly Memphis, and here certainly Detroit, which is a little bit more of a risky market. But the housing inventory there is older, and you can testify this in Cleveland. And so there is an opportunity. A lot of the folks coming in and wanting to own these single-family rentals may be coming in from out of state or not familiar with the area, and they really want the so-called turnkey rental, or at least a property that's in rent-ready condition. And one of the things we see is there's a high percentage of home flips that are going to cash buyers, and to us in some of these markets is that home flippers are tapping into the single-family rental market by providing properties that are rent-ready, and so the investor, the more passive investor who's buying that as a rental property, doesn't have to do all that rehab to fix it up. I know I've looked at the numbers in Memphis recently, and it was about 40% of all homes that were flipped there went to a cash buyer, as opposed to only single-digit percentages went to FHA buyers, which would indicate like a first-time home buyer.
Sure.
So that was an interesting trend to me that ties into to flipping. Yeah.
Yeah, you bet. I have a lot of friends, students Guys even in the Cleveland market that are buying portfolios of properties, very inexpensive, fixing them up, and then they're selling them off on a onesie twosie basis to turnkey rental buyers, people that are even from out of the area, out of the state, out of the country even, but they're looking at 10, 12, 14% returns plus equity, and very stable. They come with property management, and so it's interesting to see the number of guys that are doing 150 turnkey rentals a year. So technically they would be in the flipper category, the flip niche, because they're owning that property for less than a year, but they're really selling it a lot of times, like you just said, Daren, to a cash buyer, somebody looking for cash flow, looking for something that's in great condition, looking for something that's tenant occupied and ready to go. And so, and I know guys that are doing 100, 150 of those a year, making a killing doing it. They're not making 30, 40, 50, $100,000 per flip, but they're maybe making 10 to 20,000 per flip, but they're doing it at scale. They're doing hundreds a year. It's really interesting to see that business model. And so I know that.
Yeah, very interesting.
Yeah, one of the things, Daren, we were talking about before we even got started was these, again, people scaling from mom and pop into owning a lot more units. So let's compare and contrast here, February 2017 to late November 2017, and how has the single-family rental market changed?
Yeah, and so this is February, and the broadest base of the pyramid, probably not surprisingly, is that folks who own 1 to 2 single-family rentals, 79%. It's basically a pyramid from there. It's not exactly a pyramid, but you do see those numbers smaller in pretty much every other category. There's a little bit of a bulge there in 11 to 100, but yeah. So if you switch to the November slide, it shows a pretty dramatic change. Every other category above the 1 to 2 properties increased in its market share of those 19 million properties that we talked about. The only category that shrunk was that bottom rung of the pyramid, went from 79% of the market to 67%, which is pretty dramatic. And that tells me, and anecdotally we're hearing this from operators, that, and this ties into something you said earlier, is this to me shows that it's working, and this is a good investment. And people who dip their toes in the water maybe in 2016 or earlier and bought 1 or 2 properties, or maybe became an accidental landlord, they're saying, wow, this is a great investment. I'm going to buy more. And there's also the ability to buy more is facilitated by the fact that there's better technology in finding these properties, not just in your backyard, but across the country. And there's a much better range of financing options for these investors. And so you see that was a big takeaway, is the shrinkage from 79% to 67%. And then you see people own 6 to 10 properties went from 4 to 6%, which is actually percentage-wise a fairly big increase. And then folks who own 11 to 100 went from 14% to 23%. Those are 2 that I call out that we really saw a pretty dramatic increase. And I think that 10 property limit is important because there are some financing barriers around that. And I think one of the things that we see with more financing providers out there and more flexible financing that's specifically tailored to these investors is more of them are able to get past that 10 property limit.
Yeah, I think that's a great point. For years when I got started investing in 2003, I bought my first investment property in 2001, owned a few rentals. 2004, I went full time. We knew since then that Fannie Mae and Freddie Mac, they would give you 4 loans, and that was it. And then when the real estate market started to expand, 2003, 4, 5, 6, Fannie Mae and Freddie Mac both went where they had said we would finance up to 10 properties, rental properties, investment properties for one single operator, one single borrower. And then I can't remember if it was Fannie or Freddie backed back down to 4. So one of them will fund, I believe it's Fannie Mae, will fund 4, and Freddie Mac will fund up to 10, or vice versa. But what happened out of the ashes of the Great Recession and the big real estate meltdown and all these single family operators like Blackstone and Colony. They created all these pools of rentals, and then they created lending companies. Now that they want to fund portfolios of 25 properties, 50 properties, 100 properties. The bigger the better, right? Then they're almost looking at that portfolio as a commercial loan, like non-recourse commercial financing, like an apartment building or an office building, because they can deploy tens of millions or $50 million at a time. And that filled a huge need. And I think that really, Daren, is the difference. If you asked me, again, anecdotally, just what I see, boots on the ground, not really looking at the data, but more about what I'm hearing, is those guys now that are they're confident if they go buy 5, 10, or they go buy a pool of 20 or 25 or 50 rentals, that they'll be able to get institutional financing. They're not going to have to use their own cash. They're not going to have to use their own private lenders, but they know they're going to be able to qualify for institutional money. And you see a pretty dramatic shift here, just really in about 7 to 8 months from February of 17 to November of 17, where you get a big increase in those people that own more than 11. That's really substantial. And the people even that own more than 100, from 10% to 16%, that's a 60% growth in less than 7 months. That's amazing growth in that market.
Yeah, those numbers really jumped off the page when we pulled them, for sure, and to see that. And it's certainly it supported what we were also hearing from operators as well. As there's a lot of consolidation, especially in what they call the middle of the market. Not the big hedge fund folks. There's not a lot of movement there. That would be getting into like the handful of operators who own 10,000 or more properties. We didn't look at that, but there's not really a lot of movement there. They're pretty much either holding on or consolidating. But down here a little bit further in this area, we're seeing a lot of movement. So
yeah, that's fantastic. I wanted to back up because I think this is back up on the slides a little bit to another slide that you shared with me, and really it plays in with the amount of people that are actually owning homes. So we weren't really planning on covering this, but really to talk about home ownership and how it's really dropped off. I think this is really relative to the rental market. So I wanted to kind of share a few of these slides here, even though we hadn't planned on it. But home ownership is at a 23-year low. There's longer tenure in homes. So let's touch base on this, because this leads us into the increase in single-family rentals, the increase in the number of rentals, the increase in operators doing rentals, and also U.S. home ownership rates are lower than ever, it seems like.
Yeah, absolutely. Yeah, this is the foundation of why buying single-family rentals is a good investment strategy that Warren Buffett and others have seen. Many others have seen since then. Is that the homeowners, fewer people are owning homes, whether by choice or by involuntarily, and so because of that, they still need a place to live. And that is where a rental comes in. And yeah, we could debate why this homeownership rate is at the point and why it has not really bounced back too much. It's bouncing back a little bit, and we're seeing a gradual increase in homeownership rate just over the last year. But really, there's millions of homeowners, probably 7 to 9 million, who used to be homeowners who are now renters, and that makes for a great market for single family rentals, and so this is really the foundation. And if we dig into it here this is all data from the Census Bureau, by the way. This is survey data. This isn't our data, but it's very much relied on and I believe accurate. But the under 35, that's talked about a lot. Those are so-called millennials. We are seeing an uptick there, a slight uptick in the percentage. But if you look at the 43%, almost 44% that were homeowners back during the peak of the last housing boom, versus now, we're in another housing boom, but the home ownership rate has not recovered. And so it's the furthest of any age group. It's the furthest still below its previous peak. These younger these younger folks are not becoming homeowners as quickly as they used to in previous generations, and so that's an opportunity certainly. And the great thing about single family rentals too, not to get too excited about one part of the industry, but is is that they do provide a great exit strategy. I think that these millennials, for instance, they like to rent. There's a lot of things that they like about renting, uh, but as they're hitting milestones like marriage and kids a little bit later in life, and as they hit those milestones, many of them will still want to become homeowners. And the beauty of a single family rental is if the market shifts dramatically back toward homeownership, it's a great market to sell, liquidate those single family rentals if that makes sense for you.
Yeah, absolutely. That's going to be a time where there's going to be an exit, selling some of those properties off to an owner-occupied buyer, converting some of those tenants into buyers, or selling on rent-to-own, converting internally within that property, converting the tenant into the owner is a great way to maximize your profit because somebody doesn't necessarily want to move from that house. They want to stay there. They feel like they're already sort of an owner because they've been there for so long. And I agree. We could debate it all day, but I see it. I see a bunch of my friends who are now north of 40 years old having kids. I see, people in their late 20s, 30s, who whether it's the Great Recession and delaying them having stable jobs, but also I think they're used to technology. They're used to the ability. And they're more than ever grasping the concepts of technology and flexibility and freedom to be able to move and not be tied to a house, not be tied where they can travel. I'm amazed at how many people I know who are in their 20s that are owning businesses, starting companies. They want to travel, they want to be able to move around, and their businesses are not always very mature or very stable, and so they don't want to own a house. They don't want to be tied to a business and a house. Versus in the past, if you look back 50 years ago, the American dream was get a job with a big company that you could stay there for 30 or 35 years, get married, have kids, and buy a home. That was the American dream. It's not really the case anymore. A lot of people, the American dream is start a company, right? It's like Shark Tank,
Yeah.
it's start a business, it's start an app, something with tech. And that doesn't necessarily mean that they want the stability of a home. They don't want the mortgage payment or the obligation of taking care of a yard and grass and landscaping. They really want the flexibility, especially if their business fails, to be able to be flexible. And so it's really amazing what's happening. So even in this 45 to 54-year-old category, there's some things changing there too.
Yeah, this is kind of a forgotten piece. I feel like maybe because I fall. Actually, I don't quite fall into this, but I won't give you my age. But this is close. I mean, this is how the Census Bureau divides it up, and this is basically what I'd say is Gen Xers and maybe young baby boomers right here. Their their home ownership rate is continuing to fall, whereas we saw with the millennials under 35, there has been an uptick in the last few years. These folks are at an all-time low, and some in the industry believe that these folks, many of these were these. I believe this generation right here, this group, age group, was hit the hardest probably by the foreclosure crisis. They had bought their first home near the peak of the housing market, or maybe their second home, and many of them lost their homes to foreclosure. And there was some expectation that these folks would eventually come back and become so-called boomerang buyers. I think with this data, we're seeing that has at least has not been the case yet, and they're getting older, so it's hard to imagine that. My interpretation for a lot of these folks is they're saying, you know what, home ownership is just not for me. I'm gonna stay as a renter, and this is a really ripe part of the market for single family rentals is to look at that group as opposed to even the millennials because that their home ownership rate continues to decline.
Yeah, I definitely think that those, and I think about the different generations, the baby boomers that were very stable and, being at a job for 30 years, 35 years, pension, health benefits, long marriage, long home ownership rate. And then the millennials who were kind of forced to be very nimble, flexible. I agree with you. That group in the middle, that 45 to 54-year-old group, not only did they not have companies that stayed with them, they did, they had the foreclosure crisis and the Great Recession that happened. They've been, had to be very, very flexible, very on the kind of the tip of their toes because, bankruptcy, divorce, foreclosure, not a very stable job or very stable company. They had to deal with all of that. And the last thing you want with all of that chaos is to be tied to a mortgage payment.
Yep.
And so I can see it just, again, anecdotally, just talking to friends and seeing people I know in that market, in that age bracket. That's definitely what I see. What's interesting too, Daren, is the people that are in their home are staying longer and longer and longer than ever.
Yeah, and this is data that we've pulled here, and it kind of supports the low home ownership rate in a way. And it's really, I mean, this is another one that just, the first time we pulled it, jumped off the page. There's this dramatic shift. There's a dramatic turning point where the numbers started going up, and that happens to be, not coincidentally, right at the end of 2008, where you see that trend line take a dramatic shift and start going up. Before that, we were seeing consistently between 4 to 5 year average tenure in a home before someone would move up into a different home, most likely. Now we're seeing that is almost double, up to 8 years on average. And part of this was by necessity, I think, early on. Folks all of a sudden lost a bunch of equity in their home when the home values went down, so they weren't able to follow the typical move-up pattern and move into a bigger home, leveraging the equity from their old home. But then we've seen home builders also become very conservative in the wake of the Great Recession to build a lot of new homes, and so there's just not a lot of inventory now that many people have recovered their equity and could move up into, say, a new home. But they're not doing it partially because there's not a lot of inventory. And then also this ties into the shift away from home ownership. As you see, during this time period, more properties have shifted from owner-occupants to investors. I think what we see with investors is that they tend, especially, of course, the single-family rental investors, they tend to hold on to the properties for a longer period of time than an owner-occupant would.
Yeah, it's amazing. It all ties together. If you're looking at all the different data, you can arrive at a conclusion that less people are, people that are in a home are staying. That people that are tenants, are staying as tenants, and less people are buying. The builders are not building as many homes as they used to, so there's less inventory. Property values are going up across the country, and the number of rentals are going up because the financing is available, and it's really professionalizing the business. The amount of technology, the amount of money that's flowing into single-family rentals to help people professionalize that business and really grow their portfolio is really amazing. And so, this all leads, of course, I'm all in on real estate. Is anybody that's ever watched one of my webinars, my interviews, one of my podcasts, or one of our customers knows that I'm all in on real estate and have been for a long, long time. But the data is there, for that person who can buy rentals, own them, manage them, or have somebody else manage them. If you're paying all cash, there's the opportunity to significantly and consistently get an 8, 10, 12, 14% return on investment if you're paying all cash. It's called cap rate. If you add in leverage, because there's a lot of capital available for financing, if you add in leverage, it's going to allow your return to go up into that, high teens, low 20s, and sometimes even into the mid 20s using leverage, using a loan. It's really an amazing opportunity that's happening right now. And so I know, Daren, you have another interview coming up, so I want to bump back to our original slides and kind of wrap up this conversation on rental properties. But you guys aggregate a ton of information, a ton of data, and you guys put out these white papers pretty often to allow people, the opportunity to either go to your website, check out the heat maps that you guys offer that are free, that are available. You have white papers that people can download to get even more in-depth information. So why don't we start with some resources that Adam Data Solutions has available for investors, for my students, and for clients that'll watch this interview. what are some things that you guys have, these interactive heat maps and things? Tell us where they can go to check out their own market.
Sure. A couple completely free resources. We're putting out reports almost every week, maybe once every other week, on the housing market that covers different aspects of the housing market that we're seeing in our data. And you can just go to adamdata.com and just click on news or /news, and you'll see all the most recent reports there. You can go through all the previous ones as well. We do incorporate a lot of heat maps like you saw there. These two slides are from one of those reports. We cover a wide range of topics, including foreclosures here in this heat map. And so that's one free resource is adamdata.com /news. Another is if you go to adamdata.com, and I know this is kind of a long link here, /landlord-land, or just if you Google landlord land, this should actually become, I think we did a good job on this, should be the first one that comes up on a Google search, landlord land. It's a white paper you can download. It's, I believe, about 15 pages long, really goes into depth, even more than what we did today on this phenomenon of single-family rentals and the institutionalization of that, and how that's impacting different markets. And then I would say I mention one more thing that's a very practical tool, and we've talked about it at your conferences before, is our marketing list tool to identify properties to acquire for investors. If you go to, now this is under a RealtyTrack brand, marketinglists.realtytrack.com. I don't have it here on the slide. That's a great resource. It is 15 cents a record to download, but what you can do is go in and set a bunch of filters and say, these are the type of properties or homeowners I'm looking for, and whether they're in foreclosure, whether they have a certain amount of equity, whether they've owned the home for over 10 years or something like that. There's a bunch of different filters you can use to create a targeted list and download that, and then reach out to those homeowners. Because one of the things, when Warren Buffett talked about buying hundreds of thousands of properties, he said distressed properties. He saw the foreclosure crisis as an opportunity to acquire properties. Foreclosures have very much dried up as acquisitions. So most of the investors I talk to are focused on off-market properties that have some kind of motivated homeowner, and that's what that marketinglist.realtytrack.com helps you identify. So with that, that's some of what we've got. We do have a newsletter we publish as well. I should mention that.
Yeah.
And that we'll give your listeners a free subscription to that. It's usually $100 a year if they email marketing@adamdata.com.
Fantastic, Daren. I know you're a busy man today. Lots of stuff going on in the real estate market with Amazon's announcement as well. I know you got to jump. So thanks so much for the opportunity just to be with us and share this information. Look forward to seeing you. Daren speaks at most of our annual conferences, the Flippin' Funds Summit. We do have our next Flippin' Funds Summit coming up in April 2018 in Dallas, Texas. Check out flipandfund.com for special pricing on tickets. And again, Daren, thanks so much for all the great information that you guys have on the marketplace and are able to share with us so that we can really formalize and professionalize our real estate investing business. Again, one more time, guys, check out adamdata.com /news or /landlord-land for all of that free information. Daren, thanks so much again, my friend. Really appreciate it.
Thank you, Josh. It's great to be here.
All right, guys, thanks for joining us again for another episode of Strategic Real Estate Coach Radio. If you enjoyed this episode or previous episodes, leave us a comment below. Leave us a rating, a 5-star rating, a review. Tell us how we did today. We look forward to sharing more information with you to help you grow and scale your real estate investing practice. We'll talk with you soon. Take care.